All right, welcome to this explainer. For all you CMA students out there grinding away for your upcoming exams, we're diving deep into the Companies Act today. Specifically, we're putting a laser focus on Sections 139 and 141. You know, the rules that dictate exactly how auditors are appointed, what happens when they suddenly vanish, and the absolute legal limits on their workload. It's a super testable area, so let's make sure you have it totally locked down.
So, here's our roadmap. We'll be covering handling a casual vacancy, CAG versus non-CAG companies, the rules for auditor reappointment, the audit committee's role, the famous 20-company audit ceiling, and finally, how to calculate your audit limits.
Section 1. Handling a casual vacancy. Okay, picture this. You're advising a company, everything's going smoothly, and boom, they suddenly find themselves without an auditor right in the middle of the year. Examiners absolutely love this trap. What happens when an auditor just quits out of nowhere? They're going to test you on the exact legal protocol to get a replacement, who actually has the power to appoint them, and the strict deadlines they're up against.
Well, first, let's make sure we're on the same page with our terms. The law usually implies that a casual vacancy is the cessation of an auditor service due to death, resignation, or suddenly becoming disqualified under the Act. Basically, an unplanned, sudden exit.
Now, check out the strict timeline triggered by that sudden exit, specifically a resignation. The clock starts ticking immediately. The board of directors has just 30 days to act and recommend a replacement. But here's the catch. They can't do it alone. Because it was a resignation, the company absolutely must approve this appointment at a general meeting, and that meeting has to happen within 3 months of the board's recommendation. And that newly appointed auditor, they only get to hold office until the conclusion of the very next annual general meeting.
Section 2. CAG versus non-CAG companies. But wait, before you apply those rules across the board, you have to ask yourself, what kind of company are we actually dealing with? Because for your standard non-government companies, the board of directors fills the casual vacancy within 30 days, right? But for government companies, where the accounts are audited by the Comptroller and Auditor General, or the CAG, the power dynamic completely shifts. The CAG gets the first crack at it and has 30 days to fill the vacancy. The board of directors, they only get to step in within the next 30 days if the CAG misses their window. It's a massive distinction you definitely need to memorize for the exam.
Section 3. Rules for Auditor Reappointment.
Okay, so once the mid-year emergencies are handled, we settle into the standard annual routine. Now, a retiring auditor isn't just rubber-stamped back into their role. They can be reappointed at the AGM only if 3 very specific conditions are all met at the exact same time. First off, they can't have incurred any legal disqualifications. Second, they haven't handed the company a written notice saying, hey, I don't want this job anymore. And third, the members haven't passed a special resolution appointing someone else or explicitly stating that the current auditor shall not be reappointed.
But you know, what happens if the AGM is just a mess and they completely fail to appoint or reappoint anyone? Don't forget this crucial statutory safety net under Section 139(10). If the AGM drops the ball, the existing auditor automatically continues in office. Basically, the law guarantees a company is never left flying blind without an auditor.
Section 4. Audit Committee and Vacancies. Before we jump into portfolio limits, let's quickly touch on internal governance. If Section 177 requires the company to actually have an audit committee, the board of directors can't just act on an island. Whether they're making a standard appointment or rushing to fill a casual vacancy, the law makes it crystal clear. They have to take the recommendations of that audit committee into account. It's a vital check and balance.
Section 5. The 20-company audit ceiling.
All right, let's talk about an auditor's expanding portfolio and the ceiling they eventually hit. 20. Lock this number in your brain right now. Under Section 141(3)(g), this is the absolute maximum number of companies a single qualified chartered accountant can audit. And remember, the big caveat here, this strictly applies to a CA who is not in full-time employment anywhere else.
Now you might be thinking, is that literally any 20 companies? Well, not quite. And this is exactly where students lose easy marks. One-person companies, dormant companies, and small companies are totally exempt from that limit. And here's the tricky one. Private companies are also exempt, but only if their paid-up capital is strictly less than 100 crore rupees. If that private company hits exactly 100 crore or more, boom, it immediately counts against your limit of 20.
Section 6. Calculating your audit limits.
Examiners absolutely love testing your math on this with multi-partner case studies. So, how do you calculate a firm's total limit? It's pretty straightforward. You multiply 20 by your eligible partners. So a 3-partner firm has an overall ceiling of 60 company audits. But watch out, you have to exclude any partner who's working full-time somewhere else. They don't add to the firm's legal capacity at all. Oh, and if your firm does a joint audit with another firm, or even just audits a tiny part of a company's accounts, the law treats that as one full unit against your limit. No fractions allowed.
Alongside those statutory audits, burn this completely different number into your memory: 60. An auditor, whether acting as an individual or as a partner in a firm, can accept a maximum of 60 tax audit assignments. Please do not confuse the 20-company statutory audit limit with the 60 tax audit limit on exam day. I'll leave you with this final, highly testable scenario to check your understanding. Let's say a CA is a partner in firm A and also a partner in firm B. Can they just bring a 20-company limit to both firms for a grand total of 40? No way. The rules make it crystal clear. A common partner spanning multiple firms or practicing individually while also in a firm is strictly capped at 20 overall. The law keeps that ceiling absolute to maintain audit quality and prevent professional misconduct. And believe me, exceeding this limit means you are deemed guilty of professional misconduct. So if you were the auditor, how would you strategically build your portfolio of 20 to maximize your practice without crossing that legal line?
Blueprint for auditor resignation and rotation. We're going to break this down so it literally sticks in your brain, making your exam prep a total breeze. You know, we spend so much time figuring out how an auditor gets appointed, right? But the examiners, they love to test how an auditor leaves. So what actually happens when an auditor just wants out early? Or on the flip side, what if their time is simply up? This explainer is going to cover the whole shebang, both the voluntary early exit and the mandatory forced exit. All right, let's map this out. Here is our game plan for today. 1. Auditor resignation steps. 2. Penalties for resignation failures. 3. Who must rotate auditors? 4. Maximum terms for auditors. 5. Cooling off and firm rotation. And finally, number 6, manner of rotation rules. Let's get into it. Number 1, auditor resignation steps. This brings us straight into the specific compliance rules of Section 140, subsection 2. Okay, so when an auditor decides to throw in the towel and resign, the law demands absolute transparency. This is under Section 142, read with Rule 8 of the company rules. Step 1 is obviously the resignation itself, but Step 2 is absolutely crucial for your exam. The auditor has to file Form ADT3 within exactly 30 days from their resignation date. Remember that timeline, 30 days. And Step 3, this form can't just be blank. It must explicitly state the reasons and relevant facts for why they're leaving. They can't just ghost the company. Now you might be wondering, who actually gets this form? Well, it depends. For your standard companies, the auditor files Form ADT-3 with the company itself and the registrar. Simple enough, right? Actually, scratch that. What if it's a government company? Examiners love this trap. For companies owned or controlled by the central or state governments, you've got an extra non-negotiable step. The resigning auditor has to file that statement with the company, the registrar, and the Controller and Auditor General of India, the CAG. Do not forget the CAG on your exam. Moving right along to number 2, penalties for resignation failures. This is under Section 143, and oh boy, this is where it gets incredibly expensive. So if the auditor drops the ball and fails to file Form ADT3 within those 30 days, the base penalty hits. It's a minimum fine of 50,000 rupees, or an amount equal to their audit remuneration, whichever is less. I mean, imagine doing all that grueling audit work just to end up paying your entire fee back because you forgot to file one single form. Crazy, right? But wait, it gets worse. If they keep failing to file, the clock starts ticking, with a further penalty of $500 for every single day the failure continues. But to keep this from spiraling to infinity, the law puts a hard ceiling on it. The absolute maximum penalty is strictly capped at 2 lakh rupees. So for the exam, memorize the floor, $50,000 or the remuneration. Memorize the daily ticker, $500, and memorize that hard ceiling, 2 lakh rupees. All right, Section 3, who must rotate auditors? Let's shift gears from early exits to mandatory exits under Section 139. So, who actually has to rotate their auditors? First up, every listed company. Though there's a quick carve-out, this excludes one-person companies and small companies. Next, for unlisted public companies, rotation kicks in if their paid-up share capital hits 10 crore or more. For private limited companies, they get a bit more breathing room. Their paid-up capital threshold is 50 crore or more. And finally, for literally any other company, if they have public borrowings from financial institutions, banks, or public deposits of 50 core or more, yup, they have to rotate. 10 core and 50 core burn those numeric triggers into your visual memory. That takes us right into Section 4, maximum terms for auditors. Basically, once a company hits those thresholds, how long can the auditor actually stay? The absolute key here is distinguishing between an individual and an audit firm. It's like a night and day difference on the exam. An individual auditor gets a maximum of 1 term of 5 consecutive years. That's it. But an audit firm, they get a maximum of 2 terms of 5 consecutive years, which means 10 years in total. Plus, under Section 139(3), the company's members can always step in and resolve to internally rotate the specific auditing partner and their team at certain intervals, or even demand that the audit is done by multiple auditors. Let's look at Section 5, cooling off and firm rotation. What happens the exact moment that maximum term expires? Well, they have to take a mandatory break. Once an individual or firm finishes their maximum term, they are sidelined, completely ineligible for reappointment in that same company for 5 full years. And you can't just game the system by shuffling partners around under a new name. The rules clearly state no incoming audit firm can be appointed if they have a common partner or partners with the outgoing firm whose tenure just expired. It's a strict firewall. Oh, and a quick historical exam note. When this act first commenced, existing companies were given a transition period. They had to comply with these rotation rules within 3 years from the commencement date. Finally, Section 6, manner of rotation rules. Let's look at the actual procedural side of passing the baton inside the company. So, how does a company actually pick the replacement? Under Rule 6, it all comes down to the audit committee. If a company is legally required to have an audit committee under Section 177, then that committee is the one who recommends the replacement auditor to the board. But if the company doesn't need an audit committee, then the board of directors themselves considers the rotation and recommends the next auditor directly to the members at the annual general meeting. It's a simple fork in the road, but super important to get right for the test. To wrap things up, I want to leave you with a bit of a provocative edge case question to test your instincts. Does mandatory rotation mean a company is permanently trapped with an auditor they hate until the term ends, or is an auditor forced to stay with a company they want to leave? The answer is absolutely not. Section 139 makes it crystal clear. These rotation provisions do not prejudice the right of the company to remove an auditor early, nor do they touch the auditor's right to just resign from office. The ultimate power remains intact. Keep these thresholds, timelines, and exact penalties front of mind.
Look, if you're deep into preparing for your corporate accounting and auditing papers, you already know the Companies Act of 2013 does not mess around when it comes to auditors. The rules are incredibly tight, and examiners just love testing you on the fine print. So today, we're going to take all that dense legal jargon and break it down into crystal clear concepts. By the time we're done, you're going to walk into that exam room with total confidence.
Here is our roadmap for today. We're tackling this through the logical life cycle of an auditor, starting with the rotation rules, then how we fix remuneration, followed by removal before a term expires, and finally, removal by the tribunal.
All right, Part 1, the auditor rotation rules. This is all about ensuring absolute independence. Now, a massive target for multiple choice questions is how exactly we calculate the 5 or 10 consecutive years for rotation. Here is the trick. It actually includes the period the firm held office prior to the commencement of the act. I really want to emphasize this because it trips up so many students every single year. If an auditor was already serving a company for, say, 4 years before the 2013 Act even kicked in, those 4 years do not just magically disappear. No way. They are absolutely counted toward that 5 or 10 consecutive year limit. You have to look at the entire historical tenure, regardless of when the new law started.
Moving on, there's a pretty common myth out there that a company can just effortlessly hire the outgoing auditor's affiliate firm. But actually, if they share a brand or common control, they are entirely ineligible. The drafters of the law saw this loophole from a mile away. They knew firms might try to get cute and say, "Oh, our term is up, just hire our sister firm across the street. Problem solved." The law aggressively shuts this down by defining the same network. So if the incoming auditor operates under the exact same brand name, trade name, or common control as the outgoing one, they are treated as the exact same entity for rotation purposes. They are completely blocked.
So the crucial takeaway for those tricky scenario-based questions is that the law tracks the specific individual partner. To actually fulfill the rotation requirement and reset the clock, you need a continuous 5-year break in the term. And here is a classic exam trap. Imagine the specific partner in charge of an audit firm, the one who actually certifies the company's financial statements, retires and then joins a brand new firm of chartered accountants. Well, that new firm instantly becomes ineligible to be appointed as the auditor for that specific company for a full 5 years. The restriction literally follows the partner to guarantee genuine independence.
Okay, moving right along to Part 2. Fixing auditor remuneration. How does the auditor get paid?
You'll want to commit Section 142 to memory. It sets the general rule that the general meeting controls the pay, with the one specific exception being that the board fixes it for the very first appointee. And honestly, this makes perfect logical sense. The shareholders, the ultimate owners sitting in the general meeting, should absolutely be the ones dictating what the auditor gets paid to review the company's books. But when a company is brand new and appointing its first ever auditor, it's just not practical to wait around for a general meeting. So, in that one specific scenario, the board of directors has the statutory authority to step in and fix the pay. This perfectly illustrates the exact legal boundaries you are going to be tested on. Under Section 142, remuneration is a bundled, all-inclusive number for the audit itself. It includes the base fee, out-of-pocket expenses incurred during the audit, and the value of any facility extended to the auditor. But, and listen closely because this is an exam goldmine, it absolutely must not include any remuneration paid for other services rendered at the company's request. So if the auditor takes on a totally separate side project for the company, that payment is kept strictly separate from their Section 142 audit remuneration. Let's shift gears to Part 3, removal before term expiry. What happens when things go south early?
The law intentionally makes early removal incredibly difficult. It requires a highly precise 4-part compliance timeline that you must know in sequential order. You can't skip steps, and you certainly can't rush the timeline. Section 140, subsection 1, when read alongside Rule 7 of the company's rules from 2014, forces the company to jump through some major hoops with both the central government and their own shareholders.
Let's map out this statutory checklist, which is actually super easy to memorize once you see the flow. Step 1. The board decides they want to change and passes a resolution. Step 2. Within exactly 30 days of that board resolution, the company has to apply to the central government using Form ADT2 and pay the required fees. Step 3. The moment the government gives the green light, a new clock starts. The company now has 60 days from receiving that approval to hold a general meeting and pass a special resolution for removal. And finally, Step 4, which is just a fundamental principle of natural justice, the auditor must be given a reasonable opportunity of being heard.
Finally, we reach Part 4, removal by the tribunal. The absolute nuclear option.
Whether acting suo motu or based on an application, the tribunal can step in immediately if they are satisfied the auditor has directly or indirectly abetted a fraud. Suo motu is just a fancy way of saying the tribunal can do this on its own initiative, without waiting for anyone to file a complaint. Alternatively, the central government or any concerned person can formally apply. The trigger for this is incredibly severe. The tribunal just needs to be satisfied that the auditor has acted in a fraudulent manner or abetted or colluded in any fraud relating to the company, its directors, or its officers.
Watch out for this specific twist on your exam. If final orders are passed, the crushing 5-year ban and Section 447 liability fall not just on the firm itself, but on every single partner who colluded in the fraud. Let's break down how fast and heavy this gets. If the central government is the one making the application, the tribunal is on a fast track. They must issue the removal order within 15 days. From there, the government can directly appoint a replacement auditor. But here is the real sting for the outgoing auditor. If that final order is passed, they are hit with a massive 5-year ban from being appointed as an auditor for any company whatsoever. And to make matters worse, they become liable for penal action under Section 447, which is the dreaded fraud section of the Companies Act. And remember, for an audit firm, that joint liability crushes both the firm and any specific partners who actively colluded.
I want to leave you with this final provocative thought to really test your grasp on the intent of the Companies Act. Contrasting early administrative removal versus outright fraud is the ultimate key to mastering this explainer. Think about it for a second. Section 141 is just administrative. Maybe the company and the auditor simply don't see eye to eye on an accounting policy. There's no ban there because no trust was broken. But Section 145, that is purely punitive. It's a severe punishment for destroying the fundamental trust placed in the auditing profession. When you understand why these laws are written the way they are, memorizing the timelines, Form ADT-DEU, and the penalties becomes second nature. Keep these core concepts fresh, practice those timelines, and you are going to absolutely crush this on exam day.